Have you ever looked at like a really big corporation? You know those ones that seem to be made up of tons of smaller companies?
Yeah, it can be kind of overwhelming, right?
Totally.
Yeah.
And it feels like you're trying to put together a puzzle without all the pieces. You get these glimpses, but the full picture just never seems to come into focus.
It's like listening to an orchestra, but only hearing one instrument at a time. You know there's more to the music, but you can't quite grasp the whole symphony.
That is a fantastic analogy. And that's where consolidated financial statements come in, right? They're like that conductor's score bringing all the instruments together. Suddenly you can see how those separate businesses, those individual notes, create a whole economic composition.
Precisely. And today, we're fortunate enough to have this amazing collection of resources you've gathered focusing on IFRS 10.
Oh yeah, I dug deep for this one. We've got those dense guides that spell out all the rules and interpretations that clarify the tricky bits.
Not to mention some real-world examples of financial statements that really bring it all to life.
Exactly. So in this deep dive, we're on a mission to break down IFRS 10. We're going to extract those essential elements that you really need to understand, cut through all of the jargon, and figure out what it actually means for businesses and how they tell their financial stories.
We want to uncover those core insights that can be buried under layers of technical language. We're going beyond just summarizing. We're going to interpret and analyze.
Because at the heart of it, consolidation is really about taking all those financial results from the parent company and all the subsidiaries and presenting them as a single unified entity, right?
Yeah, imagine being able to zoom out from those individual snapshots of each company to see the entire economic landscape. That's what consolidation aims to do.
And the golden rule for knowing when to consolidate. When do we combine those financials?
It all boils down to one fundamental principle: control. That's the linchpin. That's what dictates whether we consolidate or not.
Okay, so let's unpack this control thing. What does IFRS 10 actually mean by that? How do they define it?
So IFRS 10 lays out this three-part test for control. You ready for this?
I'm all ears.
First, you need power over the investee. Second, you have to be exposed to or have rights to variable returns from your involvement. And third, you need to be able to use your power to actually affect the amount of those returns.
Okay, so it's not just a one and done kind of thing. All three of those have to be in place, right?
Absolutely. All three conditions are essential. No shortcuts here.
Got it. So let's break down those elements, starting with power. What does that actually mean in this context? It's not just about calling the shots on a daily basis, is it?
No, it goes deeper than that. Power, in the context of IFRS 10, means having the current ability right now to direct the activities that most significantly affect the investee's returns. We call these the relevant activities.
So we're talking about big picture stuff, right?
Exactly. Decisions about the products or services they offer, those major capital expenditures, even appointing key management. Things that really move the needle.
Makes sense. And here's where it gets interesting, doesn't it? Because you don't necessarily have to own most of the voting rights to have this kind of power.
You're absolutely right. IFRS 10 recognizes that control isn't just about having the majority of the votes. There are other ways to exert influence.
Like what?
Well, think about a situation where the rest of the shares are widely dispersed among tons of small, uncoordinated investors.
Right, like a publicly traded company with loads of individual shareholders.
Exactly. In that kind of scenario, even a minority shareholder, if they own a significant chunk, might have the practical ability to sway those key decisions.
Because they're the biggest voice in the room, even if they don't have the most votes, technically.
Precisely. It's about recognizing the substance over the form. Who's really pulling the levers?
That's a key point, isn't it?
Yeah.
The shift from just counting votes to understanding the actual ability to make those big decisions.
It's a crucial distinction. IFRS 10 is all about understanding the true dynamics of control, not just ticking boxes.
Okay, so we've got power covered. What about returns? What kind of returns are we talking about here?
So for this part of the test, the returns have to be variable. They have to be able to fluctuate. It's not about a fixed payment or a guaranteed return.
Okay, so things like profits, losses, dividends, changes in the investee's asset value, basically anything that can go up or down and directly impact the investor's financial stake.
You got it. It's about sharing in both the potential upsides and the downsides.
Which makes sense, right? If your returns are locked in, you don't really have the same level of risk and reward that comes with actually controlling an entity.
Exactly. It's that exposure to variability that aligns with the concept of control.
And then There's the link between power and returns.
Yeah.
You have to be able to use your power to actually influence those variable returns.
That's the key connection. It's not enough to just have the ability to direct the company and be exposed to its financial ups and downs. You have to be able to use your power to make those returns go up or down.
So it's about having both the steering wheel and the accelerator, so to speak.
That's a great way to put it. You need the ability to steer the company in a direction that impacts your returns.
It seems like IFRS 10 really moved away from a black and white rules-based system.
Absolutely. There's no more simply checking to see who owns more than 50% of the shares and calling it a day.
They've embraced this more principles-based approach, haven't they?
Yes, and that means more judgment is required. You have to look beyond the legal structure and really understand the substance of the relationship. It's about identifying who truly has the capacity to drive those key decisions and reap the benefits or bear the risks, as the case may be.
And that brings us to potential voting rights, doesn't it? Things like options to buy more shares. Do those play into this control assessment?
They do, but only if they are substantive. And by substantive, we mean that the holder actually has the practical ability to exercise those rights.
So it's not just about having the option on paper.
Right. You have to look at whether there are any real-world barriers preventing them from exercising those rights.
Like, what if I have the option to buy a ton of shares in a company, but the price is so high that it would never make financial sense to do so?
Exactly. Or if there were some contractual restrictions in place.
In those cases, those potential voting rights wouldn't give me control right now, would they?
Probably not. And IFRS 10 even addresses the concern about constantly reassessing control just because the share price is fluctuating. They emphasize that it's about substantive rights, and those are evaluated based on more than just the market price at a given moment.
Makes sense. Now, sometimes you see these situations where control seems a bit murky. Like, what about those cases where one company is managing another on behalf of someone else? How does IFRS 10 handle that kind of delegated power?
That's a great question. It brings us to the concept of the principal-agent relationship. The principal is the one delegating authority, and the agent is the one carrying out those decisions. The key here is to determine who actually controls the investee.
Because the agent is making decisions, but they're doing it on someone else's behalf.
Right. And the agent doesn't actually have control if they are primarily acting for the benefit of the principal. The focus is on whether the decision maker is acting mainly for their own benefit or for the benefit of someone else.
So you really have to dig into the details of the relationship.
Exactly.
Yeah.
You need to understand the purpose and design of the investee itself. What was it created to do? How are its activities being directed? The answers to those questions help us pinpoint who really holds the reins.
Okay, so we've established that control is this multifaceted concept. It goes beyond simple majority ownership. But are there ever situations where a company might meet those control criteria but still not consolidate a subsidiary?
Yes, there are. IFRS 10 lays out some specific exemptions to that general rule of consolidation.
And the most prominent one is the investment entity exemption, right?
Exactly. That's the big one.
So let's talk about that. What exactly is an investment entity? What are the key characteristics?
An investment entity is essentially a company whose primary business is investing. Their purpose is to generate returns from capital appreciation or investment income.
So they're in the business of buying and selling investments to make a profit.
Precisely. And they typically have multiple unrelated investors, and they have a defined exit strategy for their investments. Think about private equity funds, venture capital firms, even sovereign wealth funds in some cases.
Okay, so their core operation is investment management. And what's unique about the accounting for these investment entities?
The key difference is that they measure their investments in subsidiaries at fair value through profit or loss. Instead of consolidating those subsidiaries, they report them on their balance sheet at their current market value.
So they're not combining those subsidiaries' financials line by line like they would with normal consolidation.
Right, it's a different approach. However, there is one exception. If a subsidiary provides investment-related services to the parent, like management services, those subsidiaries are consolidated.
That makes sense. It's about aligning the accounting with the nature of their business. But why this fair value approach for most of their investments? Why not consolidate like everyone else?
The thinking behind this is that fair value information is much more relevant for the investors in an investment entity. These investors are primarily interested in knowing the current market value of the investment portfolio.
because they're focused on the overall performance of the fund.
Exactly. And full consolidation can sometimes muddy the waters by mixing in the operational details of all those underlying businesses. It can obscure the big picture.
So for these investors, fair value changes are like a key performance indicator. They want to see how their investments are performing in the market.
You got it. It's about tailoring the financial information to the needs of the specific users.
And I noticed that having different classes of investors or even a significant amount of debt doesn't automatically disqualify an entity from being classified as an investment entity.
You're sharp to pick up on that. As long as those debt holders are also exposed to variable returns linked to the fair value of the net assets, it doesn't rule them out.
So the debt holders are along for the ride, so to speak. They share in the gains and losses just like the equity investors.
That's right. And the same goes for different classes of investors. As long as the fundamental business purpose is investment management, those other factors don't necessarily preclude investment entity classification.
Okay, so it's really about that core purpose. But I have to ask, is this investment entity exemption a choice? Can they choose to consolidate even if they meet the definition?
Nope, it's not optional. If you meet the definition of an investment entity, you have to measure your subsidiaries at fair value. It's a mandatory exception.
So it's not a pick and choose situation. The standard sets out the rules and you have to follow them.
Exactly. It ensures consistency and comparability in financial reporting for investment entities.
Now, are there any other situations, maybe less common ones, where consolidation might not happen even if there's control?
There are a couple more, but they are less common. One applies to non-public entities like privately held companies. If they inform all the minority owners about their decision not to consolidate and those owners don't object, they might be exempt.
So if everyone involved is on board and they're not a public company, they have a little more flexibility.
Right. It's a practical consideration. For smaller, closely held groups, the benefits of full consolidation might not outweigh the costs.
Makes sense. What's the other exemption?
The other one applies when control of a subsidiary is only temporary. If a company acquires a subsidiary with the clear intention of selling it off within 12 months and they're actively seeking a buyer, they might be exempt from consolidating in the meantime.
So it's like a holding pattern. They know they're going to divest soon, so they don't go through the whole consolidation process.
Exactly. But it's important to remember that this exemption is generally not available to public companies.
Because the stakeholders of public companies generally benefit more from seeing that full consolidated picture.
Precisely. Transparency and comparability are key for public companies.
All right, so we've talked about when a company consolidates. But what about the actual process? How does consolidation work in practice?
Well, it involves several key steps. First, you bring together the financial statements of the parent and all its controlled subsidiaries.
So you're literally combining them line by line, adding up all the assets, liabilities, revenues, and expenses.
That's right. But then you have to eliminate any transactions that happen within the group.
Like if the parent company sold something to its subsidiary, you'd remove that from both sides to avoid double counting.
Precisely. You want to present the group's performance as a whole, not inflate it with internal dealings.
And what about the parent's initial investment in each subsidiary? What happens to that?
You eliminate that against the subsidiary's equity at the time the parent gained control. This is also where any goodwill or bargain purchase gain from the acquisition is recognized.
Ah, so IFRS 3 business combinations comes into play here.
Exactly. IFRS 3 guides us on how to account for those acquisitions.
Makes sense. So you've combined the statements, eliminated the internal stuff, and accounted for the initial investment. What's next?
The final step is allocating the comprehensive income and equity between the parent company's owners and any non-controlling interests.
Ah, yes, non-controlling interest, or NCI. That's the portion of the subsidiary that the parent doesn't own, right?
Exactly. It represents the equity held by other shareholders in the subsidiary. And we present that NCI separately within the equity section of the consolidated balance sheet.
So we're recognizing that even though the parent controls the subsidiary, there are other owners with a stake in its performance.
Absolutely. It's about providing a complete and transparent picture of the group's ownership structure.
And what happens if the parent decides to buy more shares in a subsidiary they already control? How is that accounted for?
Generally, those transactions are treated as equity transactions. It's seen as a deal between the existing owners of the parent and those who held the non-controlling interest.
So it's like reslicing the ownership pie.
That's a good way to think about it.
And on the flip side, what happens if the parent loses control of the subsidiary? That seems like a pretty big deal.
It is. When that happens, the parent removes all the subsidiary's assets and liabilities from its consolidated statements.
So it's like they're cutting the cord.
Yes, and any remaining investment the parent keeps in the former subsidiary is measured at fair value on the date control is lost.
So they treat it as a fresh investment at that point.
Precisely. IFRS sees this loss of control as a fundamental change in the relationship, so it's reflected in the accounting.
Now, I know there's been some research into how the adoption of IFRS 10 has actually impacted companies' reporting. What have they found?
Well, one interesting observation is that it seems to have led to fewer companies consolidating subsidiaries where they own less than a majority.
So they're less likely to consolidate if they don't have that majority stake.
That seems to be the trend. And it's even more pronounced for companies that are losing money or carrying a lot of debt.
Well, that's really interesting. Why might that be?
There are a couple of possible explanations. For loss-making companies, deconsolidating a subsidiary that's also losing money can make their overall profitability look better.
Because those losses aren't dragging down the consolidated figures anymore.
Exactly. And for companies with high debt levels, taking a subsidiary's debt off their consolidated balance sheet can improve their leverage ratios, making them look less risky to lenders and investors.
So it really highlights how accounting standards can have real-world implications for how companies present themselves financially.
Absolutely. It's a reminder that we always have to be aware of potential incentives when we're analyzing financial statements.
And speaking of accounting standards, I understand that the IASB, the International Accounting Standards Board, is currently reviewing IFRS 10, along with IFRS 11 and 12.
Yes, that's right. They're conducting a post-implementation review to see how those standards are working in practice.
So they're checking to see if they're achieving their objectives and if there have been any unintended consequences.
Exactly. It's an important part of the standard-setting process. They want to make sure the standards are effective and relevant.
And while we're talking about related standards, how does IFRS 10 connect with IFRS 12 and IFRS 3? They seem pretty interconnected.
They are. IFRS 12, disclosure of interests in other entities, works alongside IFRS 10 by setting out the disclosure requirements for a company's interests in subsidiaries, joint ventures, associates, and other unconsolidated structured entities. It ensures that users of those financial statements have a complete picture of the company's involvements.
So it's all about transparency, providing those crucial details about those relationships and the associated risks.
Precisely.
Okay.
And then you have IFRS 3, business combinations, which gives us the rules for accounting for those acquisitions. It tells us how to recognize and measure goodwill and other aspects of those deals.
So IFRS 10 tells us when consolidation is required, and IFRS 3 tells us how to account for those combinations. They work together to ensure consistent and comprehensive reporting.
Exactly. They form a cohesive framework for dealing with group accounting.
And we also have those example financial statements to refer to.
Oh, yes, those are invaluable. They show how all these principles are applied in real-world scenarios.
They demonstrate how those consolidated statements are presented and how companies provide details about their subsidiaries, their consolidation policies, and the amounts related to non-controlling interests.
Seeing it all laid out in a practical context can really solidify your understanding.
Absolutely. It bridges the gap between those abstract concepts and those tangible financial reports we see. Well, we've covered a lot in this deep dive. Let's quickly recap the key takeaways for our listeners.
So the foundation of consolidation under IFRS 10 is control, which depends on those three elements: power, exposure to variable returns, and the ability to use your power to influence those returns. Then we have that important exception for investment entities, which generally use fair value accounting for their subsidiaries. And finally, the consolidation process itself involved combining those statements, eliminating those intragroup items, and properly accounting for those non-controlling interests.
It's about recognizing that corporate structures can be complex. But understanding these core principles gives you the tools to analyze those structures and make sense of their financial reporting.
It allows you to see the financial health and performance of the entire economic group, not just its individual parts.
So it's like having X-ray vision for businesses. You can see through those layers of complexity to the underlying economic reality.
And that brings us to a thought-provoking question for you, our listener. As global business structures continue to evolve and become even more intricate, how might those accounting standards for consolidation need to adapt? How can they keep pace with those changes and continue to provide the most relevant information to users?
It's a question worth pondering. And as we've seen, the shift toward a more principles-based approach in IFRS 10 means that professional judgment plays a more crucial role than ever before. So how do we ensure that judgment is exercised effectively and consistently when assessing control, especially in those more complex scenarios?
These are questions that will shape the future of financial reporting. And we encourage you to delve deeper into those source materials we've discussed today and consider how these principles apply to the specific companies or industries that interest you. It's in that exploration that those true insights are often revealed.
Absolutely. So keep asking questions, keep challenging assumptions, and keep learning. That's the best way to navigate the ever-changing world of finance and accounting.
We'll see you in our next deep dive.
Until then,
Yep.
happy consolidating.